What is going on, guys? We've got a couple people in chat already. If you are tuning in, this is a live coverage of the FOMC decision. It's going to be coming out here in just about 5 minutes. It is 1:55 Eastern Standard Time, and the decision should be coming out here at 2 p.m. So really exciting news. This is obviously extremely market moving, although more than likely what's going to happen today, my prediction is that it'll trade sideways. There'll be a lot of volatility seconds after the decision, but I don't think that there'll be tons and tons of volatility throughout the rest of the day, and even tomorrow may be sideways, but it is going to be Friday where I think that the market will have time to digest and start moving in one direction or another. But before we get ahead of ourselves, we've got a countdown here to the rate decision. I've got a bunch of different tabs opened up here to make sure that we get the right one out. It is just going to be me today. And if you're joining for the first time and you're completely unfamiliar with the Investing Bros channel that you're tuned into, welcome. Go ahead and like and subscribe if you're really interested in investing and Fed moves and what the Fed is looking to do and the way that monetary policy shapes the world of money, the future of money, and ultimately your portfolio. So definitely give us a subscription, give us a like, and even hit that notification bell if you want to stay up to date on what matters in investing in the crypto markets, in investing in the stock markets and commodities, and sometimes even Forex. So we are here. I am Investing Bros. Just one half of the Investing Bros. The other half is out in the kitchen on a business call. He might come in to chat with us, but I thought I'd go live for you guys and we can get a little something going here. It's 1:56, about to be 1:57 Eastern Standard Time, so we've got about 3 minutes before the decision hits the wire and markets start to react. Let's go ahead and take a look, a very quick look here, because it's going to be dropping here very soon. But let's take a look here at how markets are positioning themselves. Oil has taken a huge hit, really sold off in the early minutes leading up to this decision. And so you can see here, man, it has come way off of the $83, and it's come down, and it's looking like it's wanting to test this line of resistance, or this line of support, excuse me, that it had flipped a while ago, back in January 10th, so early January. I'll go ahead and extend this line out because we may be watching this chart a lot. Indexes, as you can see, indexes are red, but moderately so. It's not really seeing a ton of selling into this decision, which would make sense. Folks have positioned their portfolios and they're not wanting to budge too much. Crypto is pretty much red across the board, although Atom is green, up almost 7%, guys. AVAX coming in and leading the market lower as it's down 3.6%. Let's take a look here at metals. Gold and silver, not really changed too much, down a little bit, down 0.9. Cryptex is in the chat. He said that he's excited for the volatility. Yes. Again, I'm predicting that in the first couple seconds, all the algorithmic and robot traders will absolutely cause quite a bit of volatility in the first couple minutes, but I think a lot of that washes out, and it will more than likely be 25 basis points. That's something that I should mention. It's more than likely going to see 25 basis points here. We can look at that predictor in just a minute here. Actually, we may not even need to look at the predictor here. So you see Microsoft, Apple, all the other large caps, pretty much red, but not super red. Apple is actually kind of, getting sold off a little bit today. But let's go ahead and do that. Let's go ahead and take a look. Leave this unzoomed out. Let's go ahead and take a look at, this is the FOMC website. This is the live stream that we're going to be going to. But just so you know, guys, if you're just tuning in, Jerome Powell will not be going live until 2:30 p.m. here. So you're going to be hanging out with me, and we should be getting the print here in just a second, in about 40 seconds Eastern Standard Time. By the time you're hearing my voice, you may have refreshed a page and seen exactly what they've said, but we'll be bringing that to you here in just a second. I've got a couple of different tabs here, and then we're going to go through Twitter, and we're going to go through the Wall Street Journal. We're going to see how CNBC interprets it. 20 seconds here, guys. So exciting! It's like New Year's Eve. So the forecast again is 4.75. Previously it was 4.5. This is the Fed interest rate. Should be coming out here in about 5 seconds, guys. I'm going to keep refreshing the page here and open up this PDF as fast as I possibly can. All right, it is 2 o'clock, so we should be getting, there it is right there. Can't get to it fast enough. All right. So the committee decided to raise the target range for the federal funds rate to 4.25% to 4.75%. So that's pretty much exactly what we were expecting, guys. So not a huge surprise there. As predicted, you see actual forecast in synchronous there. So a 25 basis point hike is exactly what we got. So let's go ahead and see how Twitter's reacting. I've got Zero Hedge pulled up here. I know it's got kind of a weird profile picture. I don't know why they do that, but this is an extremely reliable source. So far, no tweets except for just the price, or except for just the rate decision. So you can see that there. As predicted, Fed repeats ongoing rate increases will be appropriate. Let's go ahead and read, guys. Let's go ahead and read this PDF. It more than likely is going to be the exact same rhetoric from the last time, and what is interesting will be the rhetoric that has changed. And then we're going to be jamming out here. We're going to see with how the Wall Street Journal reacts, how Twitter, and how the market reacts. But before we do, let's read this. And before we read this, actually, let's go see how the markets are reacting. So big tech, we'll start with that. Really unchanged from this decision. Again, a lot of everything was baking in 25 basis point hikes, which is what we got. Yeah, as you can see here, not really any moves. Let's go to a zoomed in SPY chart here. Let's go down to the 1 minute. Well, let's go down as far as it'll let us go. Okay, there's the 5 minute. Let's check this out here. Yeah, so exactly as I predicted, guys. It happens almost every time. Huge volatility up and down, but it doesn't really actually change. This is on the 5 minute chart, so but it really doesn't. It's a wash, right? It's right back where it started the minute before. So that's kind of what I was expecting. And now for the rest of the day, more than likely it'll trade sideways with minor volatility in the minutes charts. But if you go back on the even the 1 hour chart, you can see everything's just, well, if it'll load here, yeah, it's just sideways, guys. So no real big movements as of yet, although we did get a wick down to 402 on the SPY, which is kind of a good, if you're new to trading, the SPY is kind of a good dashboard of the overall stock market in general. Let's take a look at how Bitcoin's reacting here. Bitcoin up on the news just a little bit. Not a huge surprise there, up to 23,170. And just moments before, just an hour before, it had closed a candle at $23,060. So pretty exciting stuff there. As you can see, not a huge amount of changes, except for Atom is just continuing to rip. So that's pretty exciting to see there. Huge volume spike this morning. So really exciting there. Huge volume for Atom. And yeah, metals actually, silver selling off a little bit today, down 1%, excuse me. So let's go ahead and read that, read as much of this as we can get through. Let me actually go look at the chat first before I do that. Kind of all over the place, guys. Pardon me here. So Brent Holt said, "Will do. You guys think we pump then dump?" ? As I predicted and as what has already happened, yes, there was quick pumps and dumps, but it all washed out and pretty much everything's moving sideways pretty predictably. Crypto JMP said, "Me too," at Defiant in my Captain Underpants white tighties. So a little bit of humor there in the chat. Cryptech said, "I think the real volatility will come in during the press conference." Absolutely. So the press conference is where all the fireworks are going to be today, guys. 25 basis points was the outcome. If you're just tuning in live, let's take a look at that really quick. As you can see here, the federal interest rate decision for February is 4.75. You can see it blinking there as forecasted and up from the previous rate hike there. So pretty interesting stuff, guys. This is definitely, oh, goodness gracious, I didn't go to my screen. I'm sorry about that, guys. Yeah, so as you can see here, if you're just tuning in, 4.75. So that's, exactly what was expected. But going back, yeah, so let's go ahead and read this really quickly. read as much of this as I can. Russia's war against recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation has eased somewhat, but remains elevated. Okay, Russia's war against Ukraine has caused tremendous human and economic hardship and is contributing to elevated global uncertainty. The committee is highly attentive to inflation risks. The committee seeks to achieve maximum employment, blah, 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 blah. They have their rates, they have their targets, and then this is where they reveal the actual increase there with their fractions instead of decimal points. Always gets on my nerves. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive. There's that phrase, guys, to return inflation to 2% over time. Sufficiently restrictive. In determining the extent of future increases in the target rate, the committee will take into account the cumulative tightening of monetary policy, the lags which monetary policy affects economic activity and inflation, and economic and financial developments. A lot of word salad here, guys, but ultimately, we kind of got what we expected. Let's see if there's anything new here. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information from the economic outlook. Of course you will. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Okay, so giving themselves a little bit of an out if they need to pivot, if they need to switch gears. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressure, and inflation expectations. So nothing really to see there, guys. Nothing jumping out at me as unique. Let's go ahead and look at the Wall Street. Actually, yeah, let's start with CNBC. Let's see what their headline is, how they're interpreting this. Fed raises rates 0.25%, expecting ongoing increases. That makes sense. Let's see if there's anything at the Wall Street Journal. Let's take a look over there, see what their headline is. Fed approves quarterly rate hike, signals more increases likely. Okay. And they would be getting that information from what we just read. So this is where that signal would have been, where that extra information would have been. So yeah, I was also curious if they're going to issue a report, or if they're going to do that after the release. Sometimes they issue a report. I can't remember the acronym for it, but Market Committee Statement on Longer Run Goals and Monetary Policy Strategy. That might be it. Let's take a look at this. Oh, here's the PDF. Yeah, we've got some time here before. Oh, this is a one page. That's just not what we're looking for. Yeah, this is probably what he's about to. Not what he's about to say, but this is some of the information that he's going to cover. Let's see if there was anything else that was released today on their press release site here. No, that was about it. I will drop the link here in the chat for that if you guys wanted to go read that. I'm not going to read it right now. Let's keep looking here at the Wall Street Journal. So we did that. Let's look at the New York Times. Federal Reserve slows interest rate increases. Yes, they did. That is a good way to put it. Let's see. Let's look at no, not the balance sheet. That's not coming up here for me. Give me just a second here, guys. Go off screen so not everybody's seeing my social security number and everything. Give me just a second. I've got some good tools that I like to use every now and then, and let me just get them open so that we can take a look at them and hear about what I'd say a little less than 15 minutes before we'll head over to the live stream. Oh, it's actually be quite a bit more than 15 minutes, but I'll let you guys know when we're going to be hearing from Mr. Powell himself. That'll be at 2:30 Eastern Standard Time. So let's check out the chat here. Cryptex said, "Good afternoon, Mr. Shrum." Good afternoon to you, Cryptex. For those of you who don't know, Cryptex has been instrumental, and we would not have been able to do the Discord, release the Discord without him. He basically built all of it in collaboration with the CryptoSec guy and with obviously Tim and I. And, super big thanks to him. We would not be able to be where we are today with the Discord and the Patreon without Cryptex. So by the way, guys, if you don't know who we are, I am T-Shroom coming at you live, covering the FOMC decision today, which is 25 basis points, exactly as predicted. But we also have a Discord and a Patreon where we talk about investing all day long. We are literally in that Discord 24/7, except for when we sleep. And even sometimes I'll wake up and take a look at the charts and chat in there as well. So you definitely want to get into the Discord if you are interested in keeping up to date on everything that matters in the stock market and in crypto, and just finding a good community for investing ideas and bouncing on, whether it's your ideas that you're bringing to the table or if you're looking for new ideas. So I've got a couple more tools here pulled up. I want to show you guys a quick little history of where the federal funds rate has done over the years. So this is a chart going back all the way to 1954. Goodness, we don't need that much data, but you can kind of see that since 54, since basically, you know, the end of World War II. I know the end of World War II was much earlier than that, but, you know, basically the post-war era, you know, you saw interest rates rise quite precipitably, peaking in the early 80s, the early 1980s, guys. And it got all the way up. It peaked up at 20%. I don't know if it's going to be able to work with me here to get all the way up there, but it peaked just above 20%, bound around 20 point something percent, 0.5, I want to say. And from there, you know, the Fed had to bring down the rate, obviously, because you can't keep it that high for too long. But then more recently, we can take a look here. As recently as 2005, the federal funds rate was at 5.25, which is the terminal rate for what they think the federal fund rate is going to get to in our time. So they're thinking that it's going to match what we were at in 2007, and then from there, depending on how strong the recession is or the recessionary effects on the economy are, then it will either turn around and come back down, or it will remain. See how it plateaued here and it stayed the same. Also, you saw, you know, relative plateauing here. It will do something similar to that. But, you know, the Fed doesn't like to stay in the same place too long, as you can see. I mean, this does account for multiple years. You know, so when I say too long, you know, you have to take that with a grain of salt. Obviously, it's long for some people, but if you're a giant investment bank, you're planning quite a long time in advance. And if you're an investor, a retail investor, you also should be planning quite a bit in advance. So 2 or 3 years may be a short time horizon for whoever is listening to this. So let's check back in the chat. Mr. J asking the important question: was it 0.25 basis points? Was it 25 basis points? It was 25 basis points, guys. Let's take a look here again for anybody who's just tuning in. As you can see here, it was as predicted, as forecast, right at 475. We've got a bunch of cool tools here. We just went through a quick history of the interest rate and how here in March of 2022, the Fed started this crazy steep hikes. Fed hikes, and man, this rate has just skyrocketed in short order. As you can see here, guys, it really hasn't done that. We haven't gone up that aggressively since 2004 through 2006. Recently, there were rate hikes starting in 2015 that went up to 2019, but as you can see, the slope was much more gradual. So you know, the Fed felt like it needed to react extremely aggressively, and most people think it needed to start earlier so it didn't have to be quite so aggressive. But there we go. You know, that's what they ended up doing. Let's see what the prediction tool is for February. So it's still predicting February, which is interesting. I want to see if it started predicting for March yet. No, it's still predicting for February. So it went ahead and it's still at 97%. So it's a little wonky there. A little bit, just trying to figure out exactly. There's March. Okay, so March is predicting 4.75 to 5. So thinking another, what would that be? That would be another 25 basis points. So that's what's in the lead right now. And then even peering into May, yeah, so so in May, they're thinking that if there was a hike in March of 25 basis points, that by May there would be no hike. At least that is the prediction as of now. So that's what it is, guys. But the big one here is the one we just had, which pushed us up to 4.5 to 4.75. So that's really, really interesting. Let's go ahead and take a look at what the interest rates are around the world. So right now, the federal fund rate for the ECB is 2.5. And for the Bank of England, it's 3.5. For the Swiss bank, it's 1%. And for the Royal Bank of Australia, it's 3.1%. Bank of Canada, 4.5. And basically, once you get below the Bank of England, it's, these are a lot less important. But what you will notice, I'll give you a second. What is something that's extremely significant here of these rates which one is different? Which one of these don't belong? And that would be the Bank of Japan. The Bank of Japan is the last holdout. If you looked at this in the beginning of 2020, you would see that a lot of these had negatives before them. But now the Bank of Japan is the last one to have a negative interest rate. And yeah, if that leaves you scratching your head, it left a lot of economists scratching their head how that could be. And a lot of just market observers, how that could be, how there could be negative interest rates. But, that's what you have to do. So is the logic of central bank managers there. So we've looked at a couple of different tools here. We looked at the history of this would be the balance sheet, which doesn't want to load, looks like. Yeah, so this is the balance sheet for the Fed that has been rolling off quite a bit here in recent history since March of 2022. They have been selling off. Lists here what they have been buying. They've been term auction primary credit, secondary credit, seasonal credit, and primary dealer credit facilities. So these are kind of the assets that they roll onto their bank. Well, basically, what is that? It's mortgages and it's bonds, guys. Ultimately, just put plainly. And so they add that to their balance sheet to help stimulate the economy, and there you go. And now they're having to do the opposite because of how bad inflation is. So let's take a look now at the Federal Reserve stream. Let's see if they've got anything queued up, if they've got anybody leading for Jerome. My guess is that they don't. Yeah, they're still just playing their "You're on hold" music. So that gives us an opportunity to continue to make our rounds. Let's see what CoinDesk and Cointelegraph, how the crypto news is covering this. So here's Cointelegraph. Just go straight to their. Oh, look at that. That's a good thumbnail. Bitcoin awaits Fed Powell speech as sellers cement 23.5K resistance. So they actually looks like they don't have a story out yet about this. Kind of makes sense. It was only seconds ago. Let's see. CoinDesk leading with an SBF story here. Oop, didn't mean to click on that. Goodness. All right. Federal Reserve lifts rates another. Yeah, so CoinDesk has a story on it. Federal Reserve lifts rates another 25 basis points. Guys, if you're just tuning in, this that's a great picture of Jerome there. This has been the outcome. Is exactly what was predicted. 25 basis point hike. So the Bitcoin price was little changed in the minutes following the announcement. Let's go ahead and tune in to the charts. Actually, that'd be a good thing to do here. I was looking at the this is another tool, another Fed tool, CME Fed predicting tool here. As you can see, in March, it is predicting this range here from 4.5 to 4.75. But what I'll say is this one has been having a little bit of issues, so we'll just skip right on past that graveyard. Not exactly sure why that tool has been giving me issues, but all right, let's take a look and see how the markets are continuing to react. Energy continues to sell off, although oil has made a little bit of a comeback, printing some green candlesticks there on the 1 hour chart. And it looks like it's popping off of a line of support that I had drawn there. So yeah, so right on this line of support, it's getting a little bit of a bounce. So if you had been shorting oil, you may want to take profits now. I wouldn't necessarily suggest taking a long into into oil, but just a little notification out there for traders and investors. Natural gas continuing its precipitous sell-off here. Anybody long on natural gas has been really getting punished, really getting really experiencing pain there. And the NASDAQ is in the green, guys. So already seeing our first green candlestick post the first FOMC decision of 2023. Got a green candlestick there. You can see those high high volatility wicks up to the upside and to the downside. It's what you're always going to see there in the first couple minutes of the FOMC decision as the robots take over the New York Stock Exchange, and in this case the NASDAQ, to decide if the price wants to go higher or lower. About 10 minutes here before we'll tune in with Jerome Powell and see what he has to say at the press conference, in which case I will I'll play it live, and then I'll also have a window that will show Twitter and show some tweets about people kind of reacting. Crypto markets broadly selling off in the red, but getting a big pump in Atom, that it's been up 7% today, and then Litecoin also up 1.2%. Let's see who's selling off the most. Would be AVAX still. So the Avalanche project, they're still selling off that layer 1. Let's see what else we've got. The metals, pretty much unchanged, still pretty red. Seeing a little bit more green here on the large cap tech stocks, but mostly red, and Apple leading the way lower there, down 1.15%. Bond yields coming down quite a bit, although the 2-year is in the green at 0.75. Well, it was 0.75. Now it's 0.64, excuse me. Let's take a look at the Dixie, guys. See how the dollar is reacting to this. Well, the dollar had a huge wick to the upside, coming up and testing that 200-day moving average on the 1-hour chart. Let's go to the daily chart and see what that looks like. It looks like nothing. Looks like nothing happened. That's funny. That's the difference between the 1 hour and the daily chart. So really nothing to see here on the dollar, as it does what? Trades sideways. This is multi-days here. So, you know, this is just a great representation of the fact that 25 basis points was baked in, because you're just getting nice sideways movement here in the Dixie. Obviously traders wanting the dollar to come down lower, come down to the downside, and come down and test 100. So let's see what else we got down here, how oil producers are doing. Mostly selling off. Marathon actually selling off quite precipitously there. So all right, well, let's we're about 8 minutes away, 7.5 minutes away from Jerome going live. So let's go on Twitter. Let's see if there has been any developments from Zero Hedge. Sorry guys who plonked 2 million on 50 basis points 2 days ago and lost it all. Oh, I guess that's alluding to a big contract that got bought, a big put contract for this to the tune of 2 million. That's kind of wild. Let's see. Oh, this is cool. This is the lines that were omitted from the last one. So let's take a look at this with our remaining time. Let me explain a little bit of what this is. So this is the red lines are what was omitted, and I believe the underlined red words were added. So this is really important. So they have seen, so that you can see the red cross off here, that sentence said, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and the broader price pressures. And that was replaced with has eased somewhat but remains elevated, referring to inflation. So they've completely omitted this portion of their messaging here, their press release, which is interesting. I have a couple thoughts, but they're kind of undeveloped. Not really sure exactly what that could mean, other than, you know, they're wanting to simplify their messaging here around inflation. And I mean, it's not like they're trying to sweep this under the rug, you know, the more granular details of inflation, but, you know, there's a reason why they've omitted it. They've omitted the word "the war," related events arise, contributing to upward pressure on inflation and are weighing, and then they added elevated. So maybe not the best piece of information here to try to interpret orally for you all. But as you can see here, you can maybe take a screenshot of that and check it out later. It's also on the Twitter account of Zero Hedge. Let's see if there's anything else posted here. There's a pretty terrible but funny looking thumbnail. Fed hike 25 basis points as expected, maintains hawkish. Yeah. So pretty much exactly what you would expect. The line is here. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. All right, again, so we have gotten a 25 basis point hike, so the forecast was going to rise to 4.75, and the current rate met that. So the expectation was met. As you can see here, it was a rise. This is not up to date. This would be accounting for the previous, but there was a rise. And so now we're just awaiting the press conference that is starting here at 2:30, about 4 minutes away from that. I'm going to take a drink of water because hydration is key when you're trading these volatile markets. I feel like Marco Rubio there, taking a drink of water. This is a very large water bottle. And this is just all the hydrating that I do. I take hydration very, very seriously, just like Marco Rubio. All right, guys. Well, we are getting close here, about 4 minutes away from the press conference. I'm going to have Zero Hedge pulled up and maybe some other Twitter accounts too, just to kind of see how they're interpreting it. Zero Hedge is like it's a very popular media outlet for folks for traders and investors to kind of get non-biased, independent news. Let me know in the chat what you guys think of Zero Hedge. It's pretty interesting. Matt C said, T-Shroom, you think he's going to be hawkish or dovish? That's what we've been previewing every day for the last 3 shows on the Investing Bros, which, by the way, that's who you're tuned into right now. I am T-Shroom, but one of the Investing Bros. And you guys should absolutely subscribe and like this video. Is he going to be hawkish or dovish? Guys, I think you have to assume he's going to be hawkish. I think you got to assume he's going to be hawkish. And that is exactly the question that this Zero Hedge article is actually bringing up. So let's take a look at that really quickly. Go back to my screen here. Zero Hedge asking the question, watch, will Fed Chair Powell call the market dovish bluff? We shall see. So you see there a bull kind of waiting in anticipation for the hawks that seem to have fluttered around what would be I guess a bird lady version of Jerome Powell. Pretty funny stuff there. That's very cute political cartoon humor. You gotta love it. Let's see. This may be Elizabeth Warren quote here. Curbing inflation means landing plane. Curbing inflation means landing plane, not crashing it. What does interfering with an independent Fed mean? Okay, so there's some, I'm assuming that's a quote of Senator Elizabeth Warren. Not exactly sure what she's trying to infer here, but she has been an outspoken elected official who's been an outspoken proponent for kind of the counter argument to the Fed's rate hikes. So she would be counted among those similar to Elon Musk, who said there shouldn't be rate hikes, and also Kathy Woods and many, many more who said there should not be rate hikes at all. That they should either pause the rate hikes or that they should actually turn around and bring those rate hikes lower, and so pivot and start to cut the rates. So I'm going to take Eric Wallen said hydrate with some coffee. And obviously that's impossible, but I'm going to take a sip of coffee anyway. Cryptex said Brazil's rates are crazy. Yes, they are. I'm assuming he's referring here where you can see all the different fund rates for the central banks around the world. There's People's Bank of China clocking in at 3.65, and then this is the Brazilian. I don't know what probably bank, Brazilian Central Bank, I would imagine, is the name of their bank there, and it's at 13.75. Yeah, so they're I wonder if they're fighting much higher inflation. I'm not exactly sure, but here you go. This is I don't think this is the updated rate quite yet. It might be. Let's see. Yeah, so it should be now up to 4.75. So this rate here is not up to date. And then tomorrow, guys, let me show you. Let's actually see what the predictions are for tomorrow. Tomorrow we're getting the ECB rate decision. It's forecasted for 3, so that's supposed to come up 50 basis points. That's the forecast. And then the Bank of England should be on here too. I don't see it though, which is interesting. Maybe they're saying that the EU is not part. Oh, okay. So I'm got distracted here. We need to go live. Let's go make sure it's live here. I'm going to refresh the page. Yeah, so he's not out yet. Good. We didn't miss anything. I'm not a failed streamer after all. Well, guys, we'll leave it. What I'm going to do is I'm going to, continue to talk, but then when he gets up on the stage, I'll let him speak, and then probably a minute or two, I'm going to minimize this screen, and I'm going to make it to where you can see both the screen and a Twitter feed from some folks who have a really good track record of interpreting what oh, there he's coming out now. So let's go ahead and crank this volume up and hear what he has to say.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and you know, quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's
The old dot plot.
in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today.
So we're not going to get a SEP this time. We'll get one in March.
Rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, you know, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually we're close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Housing's got to come down. Housing costs.
With Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So it's a good question. I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to we have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll.
Good answer.
We spent a lot of time talking about the path ahead, and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury?
The Fed does not really concern itself with the debt ceiling. That's really out of our purview, but thank you for asking the question.
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments?
No.
Or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling.
Out of our purview.
I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility.
I literally just asked that.
And I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate.
At least he gave her an answer. The last guy who asked that exact question, he was like, "You'll see in the minutes."
2%. So that's the judgment that we made.
The lesson there is try to be an attractive-looking female when you ask a question.
And we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? You know, could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, you know, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and you know, they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may be rising to get this sector of...
Professor, my study group came to a different conclusion than you did.
A couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory.
Ooh.
And that
haven't heard transitory in a while.
Move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought. And we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to.
Reviews, thank you so much for the love. I'm curious to know what you mean by turning point. Let us know in the chat.
So I do think most forecasts and you know, my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator, of about 1%. I think, you know, most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with you know, money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So
local governments are flush with cash.
Chance that
then subsidize the utilities then
this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I
agree with you. Reviews.
Accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us?
Guys, I've got to go to the bathroom very, very bad. I will be right back.
Another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And you know, the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not, market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But we have to deliver that. And so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation.
All right, guys.
Is the hard part yet to come?
We're going to go ahead
and
wrap up the coverage there of the press briefing there. You guys can go back and watch it on your own time. That's at federalreserve.gov/livebroadcast.htm. Tim, you were listening in a little bit. Did you have any thoughts on that?
I joined late, so I even, because I saw in the messages, Matt C. was like, oh, right as I'm leaving, Tim's joining in. Which, by the way, he's back in, so his work must have come to an end too. I got a break, so I got to join you guys, so I'm excited. When I came in, and I have been wrong on this before. Sometimes I'm listening to what he says, and I have a different interpretation than others. But I'm going to be honest with you guys. What I've heard so far I'm going to say it's a little dawkish. A little bit of a mixture between dovish and hawkish. He's still sticking to his guns that he wants to get down to 2%, and inflation is not where he wants it. However, is it just me, or is there just a little bit of a tinge of optimism coming from Jerome Powell about our economy?
I think so. I mean, taking a look here at the indexes, NASDAQ up 2.1%. So that's pretty good. And Dow Jones also up quite a bit.
I just posted in our Discord this too, but I'll let you guys know. So go share my screen here real quick, T-Shroom.
There you go.
The Dixie just did something very, very important.
Oh, how low did it go?
Let's go to this one. So this line right here, this support level that we hit back in May, I don't want to get close to May, the 101.124 that we had been hesitating right at, we broke it. And just in case you guys are looking at this, I'm going to draw this line down here. This is the next level according to fixed range volume profile that could have some significance. I'll go ahead and pull it over all the way to here, though it doesn't really matter. That's the next level I'm looking at because you guys can see we just broke this level of support, which was the valley. Guess what? Now that we've hit a valley, the next part you're looking for on fixed range volume profile, you're looking at a peak right there, $98.80. That's the next zone. Then you're looking at the next valley all the way down at $97.50, and then the next peak, a very big peak, down at 96. I've heard people talk about 96 before, so that's something to keep your eyes on. Although I'm going to keep watching 98.80. Let me even pull up the Fibonacci retracement tool, and let's see if we get any confirmation from there. I'm going to go to this bottom that we had back in May of 2021 up to the peak. Let's see what we have here. I'm on the log chart, but I'm going to take a look at both. Yeah, so this level was very important, that 0.5. Guess what? That 98 comes literally right above the golden pocket on the log chart. Let's take a look at if we were to move it to linear. So we ended up rejecting. We got above and rejected right here at the 0.5 on linear, and then that 98 sitting right in the golden pocket on Fibonacci. So either way, that is a good point right there. Fibonacci and fixed range volume profile working together to give you guys a great location for the next stop of the Dixie, and that is $98.80. If we're going to find a little bit of a rebound and a bounce back up, we're looking right there. Golden pocket, peak of volume right there. That's really interesting. Very bullish for Bitcoin, which, by the way, in case you guys hadn't been watching, was moving to the upside. Let me go down and show you guys the 30-minute chart. I was just watching this, just kind of unpack, and I put this over on Twitter. But Bitcoin is sitting there up the last couple 30-minute candles. Ethereum is the big one. Ethereum outdoing, let's see, is Bitcoin, technically I think Bitcoin is outdoing prices from yesterday as well, but Ethereum getting back above 1,600 is huge.
That's big.
Cardano's back above 39. It's not necessarily quite back to where it was yesterday. We did get a flash all the way to 40 cents yesterday on Cardano. Majorly bullish, but it's making its way back up. Let's look at this. Let's even look at the bubbles here. And let's go last hour. And this is the top 100. So the biggest moving is OP, whatever this is. Let's go to
Optimism. That's a layer 2 for Ethereum, yeah.
Let's go to favorites. These are some of the ones we check out the most. Biggest movers here. Let's see. VeChain is moving big. Obviously, it's good seeing all of this in the green after it. AVAX up almost 5%. Matic 4.5. Matic's been on a tear here recently. Atom, who was on a tear this morning, still up in the last hour, up 2.3%. For the day, let me see what this does. Yeah, okay. So on the day, this makes Atom up 10%. Anyone who got in there had a nice little look at what was happening. So this is weird. I told you guys this morning, everyone expected Jerome Powell to come out and be just hawkish. But sometimes things happen that surprise us. I put over in the Discord, just so you guys know, this has changed my plans. I had plans depending on if he came out hawkish. I had a portfolio put together already. I have some money. Or some crypto. I was gonna go ahead and say, you know what? Let me go ahead and take profit here. Wait for this next dip and go in. Based off of what I just heard, I am not liquidating any of this. I think that there's a decent chance, not this necessarily run up. He didn't come out and say, "Oh, by the way, we're going to pivot." Like that was my super dovish scenario. If he had come out and said, "We're expecting to pivot this year, we're expecting this," he was actually vague. Like even that thing of like talking about the dot plots, and he kind of referenced, we've talked about we want to get up to between 5 and 525, and then he kind of acted like he was going to say something, and then he was like, "We'll cover that next month." So I'm like, oh, the fact that he pushed that down the road, that's not necessarily overly hawkish or dovish. It's not bullish or bearish. But what it does is it allows the current trend, the current momentum to come back in. And go to my chart one more time. This is really important. I talked about this the other day. Let's go to the 4-hourly chart here. Remember I mentioned that technically speaking, in this tertiary trend, this isn't a main trend. This isn't even necessarily, I would say, a secondary trend. I would call this more of a tertiary trend. We are still moving. We're setting higher highs and we're setting higher lows. And I said if we go below 22.5, which is what we hit back here, then we're setting a new trend of lower lows. Guess what? When we bounced right there at 22.5 and just matched bottoms, it kind of put us in this little lull of, hey, the trend's not officially over. It's trying to make its mind up. But with news like what we just saw, there's a chance this trend continues. Yeah. We're able to break through 24, head towards 25. And remember, when you're looking at that, going at the daily chart, those of you who maybe in case anyone doesn't watch our morning show, we've been discussing this. If we can break above 25,000, the volume that separates us between 25 and 28, there's almost none. Yeah. Could this be, I'm not talking about this is going to happen by tomorrow. I'm not talking about this is going to happen by the weekend. I'm saying give us another week, 2 weeks, 3 weeks. Could we be seeing a $28,000 Bitcoin here very soon? And likewise, could we be seeing Ethereum potentially? Let's look at what it's doing with fixed range volume profile. Could we start to climb back up towards 2,000 here with Ethereum on Cardano? Could we see, let's see what's happening with Cardano. We got several levels above us. I'm going to imagine we're going to see some resistance here, but could we get back up towards this peak, first of all, right there at 46 cents? Then you're starting to talk about Cardano. Can it make it down to this little valley here at 55? That's really close to that prediction. I've talked about 56, that if you're looking at this falling wedge pattern right here, that is the prediction tool. That is the prediction breakout for Cardano if it were to play out to its full momentum. You see right there, 56 cents. So a lot of interesting things happening for some cryptos. And again, I'm I'm happy to be wrong, and I'm sad because I know a lot of you guys, I know in our Discord, I talked about you'd already gotten out and you were waiting for the next dip. I'm not necessarily saying run back in. I still think, just in case you guys are wondering, I still think a good dip is coming. I'm not sure. I'm losing confidence about my 19.6 prediction on Bitcoin. There's still some weight down there, but part of a healthy bull run would still be, even if this price climbs up, did I get my marker? Even if this price climbs up and comes up here towards 28, you still are looking for a dip to set a higher low. And technically speaking, will this count as one? I'm not 100% certain. It's not the cleanest little low. We could at least get back down to this level, if not come back down maybe towards 20,000, and we start to make this thing where we set higher highs, higher lows. That's really bullish. So stay posted. Make sure if you do not already tune in every single morning for our morning show, you definitely want to do it, because there's some differences that happen. This meeting was not necessarily as expected. And we'll have to continue to unpack this in the future, upcoming days. Yeah, absolutely. Well, what do you say to this, Tim? Why don't we start from the top, give like a synopsis of, for those just tuning in, give a synopsis of everything we just, not everything, but summary, summary of what we observed. I'll start because I was eyes on the whole press conference. And then why don't you reiterate some of that TA there,
and maybe we can make a clip out of it. I'm not sure. We'll see. But so this is what happened, guys. Going over to my screen really quickly, we had the federal funds rate decision that came in, and it came in as exactly what was predicted. And all across the board, the New York Times, going ahead and reporting it as predicted. And he's still going right now as we're recording this. It's still live. He's still answering questions from the public. But as he is, you can see here that the prices all across the indexes for the New York Stock Exchange, for the NASDAQ, are all positive, and the NASDAQ even up 2%. Okay, some other key factors to pay attention to here is, big cap tech green across the board, green on the screen. Tesla up almost 5%. And then all your bonds or your bond yields are decreasing. The 5-year down 3%. So big bullish reaction to not only the rate hike, which was bullish, dovish, exactly what we wanted, exactly what the market was baking in and prepared for. And now you're also seeing, your cannabis stocks, your mid-cap tech stocks, all getting bought here, except Jenny is down red, probably on earnings or something like that. And then you also have oil producers down quite a bit, so rotating out of security and into tech, into risk. So Tim, why don't you, and let's take a look at crypto really quick. We took a look at the bubbles just a minute ago, but as you can see here, Bitcoin, Ethereum, moving higher. Atom just it was already having a really good day, up 6%. Absolutely monster, almost up 9% today. Tim, why don't you go ahead and bring us back through the TA that you were just doing and kind of give us some predictions about where this could go. But if I had to just summarize kind of what I heard Jerome Powell just say, it's dovish.
Yeah.
I think he used a lot of language from the past. Specifically, the policies need to be sufficiently restrictive to reach that 2% target. So it's not like they're taking their eyes off the goalpost, off the goal here, or moving the goalposts. They're still shooting for 2%, but pretty much all of the rhetoric that I heard outside of that was very, very, very dovish. And I'll give you some examples because I actually liked all of the dovish moments from the and I'll give you a couple of them there. We expect housing services to move up for some months. Yes, because so that actually isn't bullish or
wait. He said what? Say it again.
Said we expect housing services to move up for some months, referring to how shelter is actually the lagger in keeping inflation high. So it hasn't corrected and come down like energy and some other goods. And then he also said, we have no incentive desire to over-tighten rates. So that was dovish. He said, seeing progress, but without weakening in labor market, which is good. Focuses on sustained changes to financial conditions, which was a new theme that I don't think has been discussed too much, but they're kind of shifting and broadening their focus to that. And then we're not yet sufficiently restrictive policy stance. So that kind of saying, and then also he said we're talking about more rate hikes to come. So more rate hikes, but that could easily mean
he said a couple.
25 basis points.
That means 2 more 25, which gets us to that 5 to 5.25.
Yeah, the terminal rate.
So that's out of curiosity, did he mention anything about oil or food?
He mentioned no. I'm going to say no. That was pretty contrast, a pretty big contrast to previous. They even redacted that line out of the press statement.
Really?
There's a couple news outlets that do side-by-side comparisons, and the specific breakdown of the inflationary products were actually removed. So Tim, that is a summary of kind of what I heard. Dovish, baby. That was my interpretation. Now we have to wait a day. You have to let the market digest this. If you're a degen, trader, and you want to get in there and soak up the volatility right now, be my guest. Trade at your own risk. But I think tomorrow's open tomorrow's close will be indicative of what the market is actually reacting. Because right now it's anybody. It's crazy people. It's people who had just hit the bong.
It's a lot of emotional investors.
It's a lot of emotion right now that you're seeing in the market. A lot of jubilation and a lot of exuberance. I mean, you see it in me right now. I'm excited, right? doing all kinds of dovish hand signals. But Tim, I'm going to throw it over to you. Go ahead and break down for us what you're seeing on the charts and how your thoughts have shifted about crypto as a result of the of what we just heard from Jerome.
Yeah, I'm gonna start with going out here to the Dixie, and I mentioned a second ago, but I'm looking at after we just broke here. Let me get some of this stuff. Let me hide this real quick. After we just broke this key level support, I had to hide that line right here. This 101, that was very key support. The fact that we just broke that. The next level I'm watching, $98.90. This is the peak. The next peak, we just hit a valley on the fixed range volume profile. This next peak, and it also lines up with the golden pocket of Fibonacci retracement. So that is huge. And it's not a perfect thing. I've seen the Dixie and Bitcoin and crypto move similarly, but more often than not, they actually usually work in opposite directions. So that's the first thing I'm watching. We got some bearish Dixie, which should be bullish for Bitcoin. In the first couple minutes since we're heading back bullish. I think that is a point of caution that T-Shroom kind of highlighted right there. There's a lot of emotional traders trading right now, and I've seen both these things happen first. The first move can be a continuation. Like, it can continue. Right now, the first move in the last 30 minutes candles has been bullish. Sometimes we end up seeing a fake out happen. Sometimes the emotional traders buy, the bears take advantage of this. They get them into a bull trap. They take them down. But I've definitely seen where the momentum starts one way and then it continues. So this is something to keep your eye on. A good amount of volume coming in. We haven't had that much volume here for a little bit. I would say that peak and consistency of peak the last half hours, we really haven't seen since all the way back here on the 25th of January. But good start going on here. What I'm watching for with Bitcoin, I'm watching, do we break through that 24,000, which was the resistance we had here just a couple days ago? Then can we start heading back towards 25? And if we can conquer 25, easy path to 28,000. It's going to take a week or two, maybe 3. But that's something absolutely doable. Could this bull rally continue, setting higher highs and higher lows? Ethereum finally moving again after Ethereum had been kind of boring here for a little bit. What I'm looking at with Ethereum is, can we start to make an actual push here? It was one of the few coins that kind of stayed close and hovered around the 20 SMA. Well, guess what? We just bounced there once again. So can we rally, start heading back towards 2,000, mark that we hit all the way back in August here a little bit later? Notice we're talking about August prices on Bitcoin. We're not that far away from August prices. Let me see where we are with Cardano. I think Cardano's lagging a lot, though. Cardano's got a good ways to go. August prices took it back up to 60 cents, but Ethereum is one for sure. I'm looking. Can we start heading back towards that August high? Speaking of Cardano, going to Cardano again, that's one of the coins bouncing off the 20 currently. That's where we came down to. But now we're wrestling, got rejected at the 200. So first major bullish move for Cardano if it wants to go up. Break back above. We're hovering right below it now. Break through that 200 daily SMA. Start heading back up here towards this line. This is the 49-cent prediction. Didn't happen. The Cardano community predicted by the end of January. It's February 1st. We didn't make it there as I expected, but even better, there's a good chance 56 cents comes back into the equation. When you pull up the fixed range volume profile, this is a level. Let's see. Was it? Yeah, fixed range volume was I looking at? There's another valley right up here. Well, no, I'm looking at this valley right here, 55 cents. So right below that 56 cent level I was talking about there. But it's still anyone's guess necessarily what's happening. T-Shroom is right. Let's kind of enjoy the rallies right now. Be prepared. We're going to wake up tomorrow morning and we're going to see the real direction the market wants to move. The best way to describe this, once again, dawkish. This was a dawkish press conference. There was a little bit of hawkishness. There was a little bit of dovishness. The good news is it was a change in direction, not a pivot. It wasn't like Jerome Powell went from doom and gloom to everything's great, but the way he was speaking almost made it sound like, is he back in the camp of thinking the soft landing will happen? There's not going to be a recession. If there is one, it's going to be extremely mild. He's feeling good about himself, and when Jerome Powell's feeling good about himself and the economy is doing the things it's doing right now, whether or not it ends up turning shambles down the road for the next month, there is some bullish nature that should be coming back into risk assets. Again, I'm going to say it right here. I could be wrong. I think we're going to be in a risk-on state again, at least for another month, till we see the next level of inflation numbers, and then it's back to the drawing board. Do we need to go to continue the upside, or is it time to go back down?
Yeah, absolutely. That's kind of what I was taking from this fresh new information about our economy, about the market. Giving us a lot more data to the question. The ultimate question is the bottom in for Bitcoin, for stocks, and for many other risk assets around the economy. Well, thank you so much for watching, guys. We're going to go ahead and cut it off there. We have been the Investing Bros. I am T Shroom, and this is Tim over here. Make sure that you subscribe if you like this show, and please leave us a like. Again, thank you so much for watching. See you in the next video.